Fernandez, thanks for joining us on Market Call. Brian Madden on the show today. He's Chief Investment Officer at First Avenue Investment Counsel, and he's going to take your questions today on North American equities. Call us toll-free 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Brian, thanks for coming in today.
My pleasure. Good to be here.
We're seeing some recovery in the markets, but it almost feels like just as we begin to see a bit of stability, there's another tariff threat sort of thrown into the mix. I'm wondering whether you think investors are calming down and are less reactive now to what they're hearing.
Maybe there's some evidence of that, Marilla, but you're right. It has been, quite an eventful first almost 4 months of the year, and especially the last 3 weeks since so-called Liberation Day or Liquidation Day. Maybe it's more aptly
probably better
named. I think people are starting to catch on to the fact that the White House says one thing today and negates it tomorrow, and so they might be a little bit less trigger happy. And hopefully, that thinking fast and thinking slow, the slow part of the brain is kicking in, and there's some longer reflection before knee-jerk reactions are made to tweets and, sort of off-the-cuff remarks. A lot of volatility for sure. Okay,
let's talk a little bit about some of the earnings we're going to see this week. We're getting some of the tech leaders who are going to report after hours. Alphabet's going to be tonight. Do you have any expectation overall from the Magnificent Seven, where they're going to go, what to expect for first quarter results?
Well, I think it's really sort of a tale of, it's a disparate group of stocks now, which is not really the way that they traded for really all of last year and 2023 as well, for that matter. So, the ones that we like are the ones that are sort of more into the recurring revenue and the service sector part of the economy. We saw, one of the first of them to report earlier this week. That was Tesla, and it was really a bomb of a quarter. And I don't need to bore your viewers with all the reasons why that is, of course. But Google sort of skews more to the service sector side of the economy, which obviously is scoped out from tariffs. And, Google obviously has just a very, very robust business, is the dominant player in search advertising. So, we have no undue concerns about that quarter. Beyond that, there's obviously the cloud business, which is growing nicely for all those that are involved at scale in that business. And Google, we expect we'll see more of the same there. So, it should be okay, we think.
Are you worried about a lawsuit in the U.S.? They have been accused of monopolizing with their search engine some of the advertising revenue there. I'm just wondering if you worry about that down the road.
Not unduly. I think a lot of these things with the DOJ and the antitrust investigations, it's more bark than bite. Very few of them really come to fruition or require strong remedies. So I think it's more of a headline risk than a fundamental risk to Google at this point, frankly.
Got it. Okay, we are going to go take a break. Brian Madden's sticking around to take your questions. He's Chief Investment Officer at First Avenue Investment Counsel. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We want to get right to your questions. Ash has written in an email from Stratford, Ontario. It says, what are your thoughts on the stock of Live Nation, a New York Stock Exchange? Is it a buy now? We'll pull that chart up in a moment. Live Nation is growing, right? They're building, I guess, arenas and auditoriums, that kind of thing.
Yeah, they are. It's really more of an asset-light business, though, frankly. It's obviously the dominant player in concerts and ticketing. They also drive some revenue from advertising and sponsorships. It's a stock that we don't own right now in either of our two equity mandates at First Avenue Investment Counsel. We did own it in the past. But moved on. It's obviously a great business in essentially a de facto oligopoly, some might say monopoly in certain categories of entertainment. But it's pretty richly valued. It trades at 44 times earnings. And really the valuation on this, when you look at earnings, has been all over the map over the last 5 years because, of course, the earnings were absolutely decimated during COVID. When live entertainment and anything discretionary was sort of ground to a halt. And then it recovered mightily in 2021 and 2022 as the revenge spending and travel and experiences came back with the vengeance. And then, of course, last year, there was the whole Taylor Swift phenomenon, whatever that was, but obviously played to their advantage and anyone in that ecosystem. But right now, with the stock trading at 44 times earnings and the recovery behind us, you're sort of still growing, but not at a pace that would warrant a multiple that lofty. The consensus has earnings per share growing 9% this year, 8% next year. So, we can find a lot of stocks that are growing at 8 or 9%, trading below 20 times earnings, let alone, 30 or 40 or 44. So we'd give this one a pass right now.
Got it. Okay, let's get to the phone lines then. We have Jim calling us today from Elliott Lake. Hi, Jim. What's your question today?
Good afternoon. Brian, what are we going to do about these Canadian telcos? It's just been ugly. I know TELUS has been a bit better, but, I can only talk about their dividends so much, because at some point you need to look forward here with the performance of the stock. But my question to you is, do you hold? Are you participating? Are you staying away? If you're looking forward, I'm not asking about 3 to 5 years out. I'm asking more just, what do you see 1 year out for, the Rogers and the Bells of the world?
All right. Thanks for the question, Jim.
Yeah, thank you, Jim. You're right. It's been a challenged sector for the last several years. Fared relatively better during the pandemic and not very well at all, really, since interest rates started rising. So there's a couple of things at work here. One is interest rates went up a lot. We all know that. These stocks, I'm liking them to bond proxies, meaning you own them for the income. That's pretty compelling when you have financial repression, as we did from 2008 through to 2022, where rates are near zero and you can get a 4 or 5% yield from the telecoms. People buy them all day long. Beyond that, they were growing their dividends. So that is less so the case now. Obviously there is open speculation the BCE will cut their dividend. We think that's pretty much a certainty. The question is not if they will, but when and by how much. And the best case scenario, the most likely scenario, is probably a cut somewhere between 40 and 60%. TELUS, we think the dividend is more secure. We do, in fact, own TELUS, bought it late last year. And are pretty happy with the current income. It's yielding about 7.5% right now. Contrast that with BCE, where the yield is 13%. That's a screaming red flag. It's telling you the market doesn't believe the dividend is sustainable. TELUS, on the other hand, has continued its cadence of dividend growth. It's increased it, I believe, 3% in 6 months intervals in each of the last couple half-year periods. So they might have to slow that pace, but we think their dividend is sort of on a level footing. And we do think that the price war that all of these companies waged upon one another to no one's benefit, other than the average Canadian who owns a cell phone, is sort of abating or not worsening. And so you'll start to get easier earnings comparisons. And in the case of TELUS, there's some self-help opportunities, like selling non-core real estate and monetizing what they think is $1 billion worth of copper in some of these old telco substations. Maybe spinning out some of the smaller ventures they have on their balance sheet. So we think the total return story will pivot to being more of just sort of income offsetting stock price depreciation. But, we wouldn't necessarily be buying the whole sector broad stroke brush. We think you got to pick your spots. TELUS is the one that we like there. The other ones we would not be buyers of.
Okay. Just want to remind people that Bell Media is a parent company of this channel under BCE. As we move on to the next phone call, which is from Elliot calling in from Hamilton, Ontario. Hi, Elliot.
Good afternoon. Please, are the current market conditions good for a company like TMX Group? Your assessment, please.
Thanks for the question, Elliot. Yeah, boy, are they ever. It's just about as good as perfect. This is the company we own. Our dividend growers mandate have owned for years. Best known as the parent company and operator of the Toronto Stock Exchange, but also the Montreal Derivatives Exchange and a stake in the Boston Options Exchange. In terms of the Toronto Stock Exchange, where this business has its roots and origins, Market conditions are not great for primary issuance, which is to say companies doing initial public offerings or additional equity financings. However, this company in that business makes money in two ways. One is from listing fees and sustaining fees, meaning you pay kind of a toll to keep your stock listed on the board, but also from trading activity. And the trading activity, needless to say, has been fast and furious in cash equities over the last 3, 4, 6 months, and even faster and more frenetic in the options market, where they also have meaningful businesses. But I think what also maybe is lesser known to the viewership is that they also have a number of fee-based revenues that are less cyclical and less subject to market activity. Data licenses and subscriptions, some of them in energy trading and power markets, big business in Europe and Asia in that entity, and then also some acquisitions they've made, the name of which escapes me, but a big one they did about a year or 5 quarters ago is sort of a business that enables ETF issuers to list and create custom indices and that sort of thing, which is a very secularly growing business. So
how big are those parts?
It all out.
Sorry to interrupt you. How big are those parts? The data, for example. I'm just wondering how much of its business is into that.
Well, it's more than 50% is sort of
Okay.
these recurring and subscription-based fees across these different lines of business. So it's less and less dependent on sort of trading activity and issuance activity. And that's why the shares have re-rated upwards. It's not just that the earnings are growing, but these stocks have gone from historically trading about 18 times earnings to somewhere in the mid-20s lately, and deservedly so, we think, given that it's more broadly and globally diversified, better diversified by line of business, and crucially, more recurring sticky revenues that's not market dependent.
All right, we are going to take another break. Lining up your phone calls. Brian Madden sticking around, Chief Investment Officer at First Avenue Investment Counsel, taking your questions today on North American equities. Back in a moment. Welcome back to Market Call. Let's go right to the phone lines. Michael is on the line. He's calling today from Vancouver with his question. Hi, Michael.
Hello, Marilla. Hello, Brian. Brian, thanks so much for taking my call. Brian, my question is on Microsoft. It's down almost $100 from its highs of last year and about 20%. I just thought it would be a little bit more resilient than some of the other Mag 7s that are a little bit more of a one-trick pony companies in comparison. I just wonder what your thoughts are on Microsoft. Do you like it? Do you own it? And what do you see going forward? Thanks a lot. I'll hang up and listen to your response. Have yourselves a great day.
Thanks for calling, Michael.
Thanks very much for the question, Michael. We do like and own Microsoft. I would say fundamentally it is very resilient, but like many of the other Mag 7 names, there's such heavy weights in the U.S. indices, and they got to be very crowded trades for much of the last 2 years, before things sort of turned the corner. We had a bit of a broadening out of the market initially, and then a generalized market weakness more recently in the United States. But fundamentally, this is a company that continues to grow at a compelling sort of mid to high teens pace. We think its resilience, stands near the top of the pack among the Magnificent Seven, just given some of the lines of business it operates in, notably the more personal computing segment. These are applications that are really, let's call them mission critical to both households and businesses, your Office 365 licenses and that sort of thing. Interestingly enough, they have been flexing some pricing power in some of those license renewals. My own just renewed at something like 15% higher on the annual license fee just a few weeks ago. So not great news if you're a Microsoft customer, but music to the ears of those of us who are shareholders. And that just tells you how sticky, these products and services are. People get used to using them and they don't switch, even if you increase the price. Beyond that, the big thing that's been in focus for Microsoft, and maybe the thing that took some of the wind out of their sails in terms of the price to earnings multiple derating a bit, has been their cloud computing business. Azure is what they call that, or part of it, and it's always in hyper focus when they report their earnings. it is still growing at an incredibly robust pace, something like between 25 and 30% year over year, but decelerating from the low 30s in recent quarters, and people found that underwhelming and took the occasion to lock in some profits on the shares. We think Microsoft is just one of these companies you want to own for the long haul. I should also mention there's other bits and pieces of business in there. They sell hardware, the Surfaces and the Xboxes, and they bought Activision, I believe it was, a $50 billion acquisition, which, by the way, for them is sort of a tuck-in deal, just a little bauble for them. But it all rolls up to a pretty robust business with dominant entrenched positions in their two most important segments. So, we're still long and strong in this one.
Got it. Okay, let's go back to the phone lines. Greg is on the line. He's calling from Almont, Ontario. Hi, Greg.
Hi there, and thank you, Brian, for taking my call. My call is about Marvell Technologies, and if I understand correctly, I think they're one of the prime chip suppliers to Amazon for their AI solution. Now, back in February, I bought into this stock at a much higher price, and when the AI scare came from China, it, like all the other AI chip makers, got massacred, and recently, though, it seems to have stabilized, found a bottom, and enjoying an up today. So, Brian, my question is, do you think this is a good stock over the next 12 to 18 months? And would I be wise to consider averaging down, given that I bought it at a fairly significant higher price? Anyways, thank you in advance for your response.
Let's have a look at where they are today. They are enjoying that little bump, the bit of stability people are saying.
Yeah, this is not a semiconductor name that we own, Greg, and thank you for the question. Semiconductors broadly, we're sort of like shooting fish in a barrel ever since that, what people have taken to calling the Sputnik moment, when ChatGPT made its debut on the global stage to tremendous oohs and ahs everywhere in late 2022. But semiconductors, not universally, but if one were to generalize, are pretty cyclical. And this one we think is less differentiated than some of the ones that we like better, namely NVIDIA and Broadcom. Those are bigger, and NVIDIA, of course, is just on the forefront of supplying the highest spec chips for the most demanding AI compute processes. So those are the two that we would favor in this environment. As for averaging down, generally that's not something that we're all that predisposed to doing. I think one of the most dangerous phrases that gets tossed around in investing is buy low, sell high. You can do that, but it's difficult. A better discipline is to buy high, sell higher. I understand that is not exactly sort of the motherhood and apple pie that people are used to hearing as the investing public, but that is exactly the discipline that we practice in our momentum mandates, and it works very well. Momentum is a force of nature, not only in physics and in the natural world, but in the investing world as well. So this is not a name that we particularly like, and wouldn't necessarily counsel you to buy the dips on this one, or as a general discipline.
Interesting. Okay, so we'll talk a little bit more about that later, but I do want to get to this email from Bill in Victoria. He says, hi, Brian, could I please get your opinion on Micron, and is it a good time to buy Micron like many of the tech companies? On the downslide, and with your philosophy in mind, would you buy right now for Micron?
No, we wouldn't. So thanks for the question, Bill. This one, the answer kind of rhymes with what I had just said about Marvell. This is, of course, another semiconductor company. This one, probably even more so than Marvell, is got hyper-cyclical earnings. This is a company that's very focused on storage and memory chips. And memory chips are, kind of a commodity, and so that's why you have big swings in the stock and in its earnings. Case in point, the consensus expects the earnings of this company to grow over 400% this year. So why is that? Is that because it's just, created a better mousetrap? Not really. It's creating DRAM or whatever is the modern iteration of memory chips. And the prices, were beaten up pretty severely last year, and they're recovering. So, if you look over a cycle, let's say going back 10 years on this name, it's generated a total shareholder return compounded of 10%. That's not terrible, but it is less than the S&P 500. And as active investors, we endeavor to outperform the S&P 500. So if we're going to take the degree of cyclicality risk that this company entails, it has a beta or market sensitivity of, I believe, 1.9, which means it's almost twice as volatile as the market. We're going to want to see commensurate return over at least the medium, if not the long term, and it's just not here in our opinion. So not a name we'd be buying.
Got it. Okay, we are going to take another quick break. When we come back, the past picks from Brian. We're back in a moment. Welcome back to Market Call. It is time now to take a look at Brian Madden's past picks. This is April 11th, 2024, so a little over a year ago. At the time, the first recommendation was Netflix on the New York Stock Exchange. It was $628.78 American. Now, a year later, it's at $1,082, so up 72% return and total return. Netflix recently reported they're doing very well. They're not talking subscribers anymore. They're not putting those numbers out, but clearly they've been doing something right. What do you continually like about Netflix?
All of it really, Marilla, and a tip of my hat to my colleague Ian Chong for leading the good work that led to this one being included in our portfolios last year. We continue to own and like Netflix. Saw the quarterly results a few days ago, or late last week, I guess it was. Pretty impressed. What are they doing well? They're cracking down on password sharing. So that's generating more revenue. They're innovating in terms of launching ad-supported versions of the offering for people who might be more price sensitive or less time pressed, depending on how you look at things. There's geographic expansion still, aggressive investment in their content library, proprietary and otherwise. Makes them the most comprehensive streaming platform out there, innovating in terms of live sports and the NFL games have attracted some interest. And then crucially, operating leverage is starting to really kick in here. So this is not just a revenue growth story anymore. It's a big free cash flow story, and they're putting that free cash flow to work, buying back their shares, and are doing a great job. And so we continue to be very happy shareholders of this company here. Very quickly,
Because there were concerns that people were going to start holding on more to their money if they were facing a recession or a downturn, would you consider Netflix under discretionary spending?
No, actually, it is classified that way by Standard & Poor's. That's the sector it falls into. But I think you can think of this as being more akin to a utility. This is the last expense you would cut if your budget is pressed. Maybe you don't go out to the movie theater or don't go out for dinner, but this is a relatively inexpensive indulgence of $20 a month for all the value that it offers. It's one that we think the demand is going to be pretty sticky for, even if you get into a more difficult macro environment. And also remember, there's people that have multiple streaming services, and this is the one that's brought us the most comprehensive. So this is probably the one where you get the most value for your money, frankly.
That you would keep. Okay.
Yeah.
Let's go to your second pick from last year, which was Service Corp SCI on the New York Stock Exchange. 70.52 recommended a year ago. Now at 80.05, so a 13% upside return and a total return up 15%. And they do death care services, so that's an interesting choice.
Yeah, it is. I shouldn't say this just a week before the tax filing deadline, but what are those two unavoidable things, right?
Yeah, absolutely.
Death and taxes. So this is the largest operator and owner of cemeteries and funeral homes in the United States. It's also a serial acquirer of an industry that is fragmented with lots of little mom and pop operators in cities and towns all across the U.S. They had a consent decree imposed on them after they acquired Stewart in 2014 and precluded them from acquiring more locations in certain metro markets. Those handcuffs came off last year, so their merger and acquisition machine might be able to ramp up a bit more actively. But more than that, there's just sort of a return to normalcy. So this is a terrible euphemism, but they sort of say a lot of demand was pulled forward, and I really struggle how to phrase this politely or delicately, but a lot of people died before their time during COVID, and
Sure.
what that did is sort of created a lull in demand for funerals and cemetery plots in 2022 and 23. And so they're sort of lapping those difficult comparisons, coming out of 2024, 25, and getting back to their normal cadence of earnings growth, which is very, very, very steady, and obviously benefiting from scale and operating efficiencies. And some changing regulations in some of their markets. So, we just think this is a very, very steady business that has a dominant position in a business that obviously caters to, a need and obviously not a want.
Got it. Okay, let's get to your last pick quickly from last year. Cameco on the TSX was 69.03 down to 58.27. So a drop return of 15% and a total return drop of 15% as well. What's going on quickly with Cameco?
Yeah, this Marilla has been a name that we've owned for quite a while, about 3 years. Bought it around $30 in summer of 2022 after Russia invaded Ukraine, which created tremendous tightness in the uranium markets, which are already getting tighter. More recently, especially after the U.S. election, the confusion around tariffs and is Washington going to broker a truce with Russia and Ukraine, or force or strong arm truce, or whatever you want to say, and is that going to bring Russian uranium and Russian enrichment capacity back onto the market? It's sort of created a bit of a deer in the headlights kind of a mindset for the utilities that are the major buyers of uranium mined by Cameco. They obviously need to replenish their supplies to run their nuclear power plants. But they're sort of sitting on their hands right now waiting for more clarity, as are so many businesses. In fact, we continue to own these shares. We're secular bulls on this so-called nuclear renaissance. Nuclear is clean, green energy. I think probably the strongest tell is the fact that they're firing up the 3 Mile Island reactor again in the Northeast. After it being idled for 40 years to power data centers. They're going to need a lot of power, and they need power that's not intermittent like renewables, and they need power that is cheap and has a low carbon footprint, and that's true regardless of where you're operating in the world. The United States might be somewhat of an aberration under the current administration wanting to fire power with coal and such, but globally, a lot of reactors getting built, and that's going to create demand for uranium mined by Cameco, which is sitting on probably the second largest stock of uranium in the world, and really the only pure play public company that's a uranium miner almost solely.
Okay, so you're going to hold on to that. We do have to take a quick break. We're going to line up more of your phone calls for Brian Madden when we come back. Welcome back. Thanks for joining us on Market Call. We are going to the phone lines. Bob's on the line from Toronto with his question today. Hi, Bob.
Hi. Thanks for taking my call. Brian, I'm just wondering your thoughts on National Bank for the short and long term. Thank you very much.
Thanks for the question, Bob. National Bank is not one of the banks that we own, but would have no qualms about buying it. We own 3 of the banks, 3 of the larger ones. This one has certainly catapulted itself from being a regional bank maybe 15 years ago, and we used to talk about the big 5 banks. Now we talk about the big 6. This is that much bigger after the acquisition of Canadian Western Bank recently. It's legitimately and veritably a coast-to-coast bank, even has some businesses outside of Canada, albeit modest exposure there. But we think it's a good opportunity for them to cross-sell products from one set of customers to the other, so-called revenue synergies as well as cost synergies, and while respecting and preserving the integrity of the culture at Canadian Western Bank that allowed them to be so successful. I think they're maintaining sort of dual headquarters, one out west and the old one, the legacy one in Quebec. Capital markets business is very good here, pretty good wealth management operation, and the exposure to Quebec, or the overexposure to Quebec historically, has actually played to their advantage over the last decade. Quebec has been a very dynamically growing Canadian province. So, I think across all segments, this is a good bank, and we'd have no qualms about owning it. And the pullback here in the stock price presents a pretty good entry point, I think.
Got it. Okay, let's move on to the next phone call from Sal in Toronto. Hi, Sal.
Hi there. Yeah, my question's on IA Financial. I was wondering if this would be a good time to add to a position, or if it's better to wait for a better entry point. Thanks so much.
Okay, let's have a look at IA Financial.
Sure thing. Thank you very much for the question, Sal. So again, another financial services company that we don't own, but would have no qualms about buying it. We don't own any of the life cos. Our preference is for the specialty financials, so some of the asset managers, as well as the banks. And in insurance in particular, we really like property and casualty. We have a number of names in that space. But if you're going to look at a life co, this one has kind of done much the same as what National Bank has done, gone from being a smaller player to moving up into the not quite the category you mentioned, the same breadth as the big ones, Great-West and Sun Life and Manulife, but closing the gap nicely. Good business in group and personal lines, insurance, and in wealth and asset management. Return on equity is good. Dividend grows pretty steadily. So yeah, no real quarrels with this one. If you want to own a life co, this one is probably as good as any. We just don't happen to own any at the moment.
Just wondering, how have the bigger insurance companies done in this period? Have they been sort of dragged down with everything else, or have they survived a little bit better?
They've been somewhat more resilient. I mean, everything has sort of been caught in the fray of generalized market weakness and then recovery in the last couple of weeks. But relative to some of the other financials, relative to the broader market, the life cos have held up pretty well.
Got it. Okay, we are going to take a quick break. We're keeping Brian Madden around to take your questions when we come back. And also stick with BNN Bloomberg next Monday evening. Comprehensive coverage of the federal election. At 5 p.m. Eastern, we will bring you CTV's Power Play with Vashi Kapellos. At 7 p.m., it is the CTV Election 2025 special. Results, analysis, perspective from all across the country. Special election coverage will continue through 2 a.m. Eastern Time. Back in a moment. Your questions, and we have an email from Lorenzo. He says, can I get your thoughts on Fairfax Financial, and do you own it? We turn that over to Brian Madden.
Thank you for the question, Lorenzo. We do own Fairfax Financial. We've owned it for a couple of years. We continue to like it. It's really doing everything right, and it's advantaged by a lot of different things. Notably, over the last 7 or 8 years, they've really gotten their underwriting house in order, and their booking combined ratios, in the low 90s, and in some segments lower than that, which means they're earning sort of 10 cents of operating profit on every dollar of policy premium they collect. And as a reminder, this is a property and casualty insurer, and big exposure to reinsurance as well, global, as well as North American business units. It's also a serial acquirer. In fact, the name itself is a mnemonic for fair, friendly acquisitions. Great management team led by Chairman and Founder Prem Watson, backed up by a long tenured group of deputies. And so, this is a company that's advantaged by rising property values. And, if you can say there's a business that's advantaged by climate change, this would be a good example of it. If you think about why, it's maybe a bit counterintuitive, but with increasing frequency and severity of extreme weather events, the price of risk goes up, which means the policy premiums go up. And if you're consistently pricing your policies to earn 90 combined ratios or 10% margins, then your underwriting profit pool is going up. And all that at a time when the company's very well-regarded investment management team has taken the float or the premiums that they're holding in reserve to back policy liabilities or their surplus, mostly is invested in high-quality bonds, some in common stocks. But obviously, the reinvestment yield on that massive, something like $50 billion bond portfolio is an order of magnitude higher now than it was 5-10 years ago. So they're earning a lot of investment income on this large and growing float. And the shares continue to trade at an undemanding multiple. And of course, the chart is validating all these things that I've said. So we've owned it for a long time and continue to like and own it in our momentum mandate.
So it's gone up a lot since August of last year. I'm not sure when you bought it. I'm just wondering, would you tell people to still buy it at where it is now? Do you expect any sort of pullback in the stock or not really?
Yeah, we hold is a 4-letter word to us. It's sort of a cop-out. Anything that we're willing to hold has to be something that we're willing to put a fresh dollar of new money into today if we get a new client or someone wants to add to their account. So for us, hold is not a thing. We are either buyers of sellers, and this is a company we're absolutely buyers of.
Got it. Okay, let's go back to the viewers' questions, which is from Vern. It's an email. Vern says, I'm interested in Mr. Madden's thoughts on Goodfellow, which is a lumber company out of Quebec.
Yeah, thanks for the question, Vern. This one, not a household name. It's small, about a $95 million market cap. It's also very thinly traded and illiquid. That's because it's 60% owned by people with the last name Goodfellow, which is to say the founding family. There are no analysts publishing research on it, and there's only one institutional shareholder of it. Fundamentally, it's not a business that we'd really want to be exposed to. So they manufacture and distribute things like siding and veneer and flooring and trim for new build and home renovation projects. Housing starts are pretty subdued here in Canada. Sentiment's not great in the sector, and obviously consumer confidence is really pretty washed out for all kinds of reasons. And home rental projects are big ticket consumer confidence signaling items. So we don't think the fundamental demand prospects are good. Also concerning, they cut the dividend in half last year, and that roughly coincides with the peak in the stock price. And the shares have come off a lot since. So the chart is not signaling a whole lot of confidence either. So probably a good idea to steer clear of this one.
Got it. Okay, let's get to one more email. This one is from Ash. Says, please give me your opinion on Arista Networks. Is it a buy at these levels, and do you own it? We'll take a look at their chart in a second.
Yeah, thanks for the question, Ash. We do own this. We do think it's a buy at these levels. This has come off mightily. We've owned this company for a number of years and have rolled it to sort of a multi-bagger outcome. We have seen steep pullbacks along the way. This is a company that is sort of upstream of the hyperscalers, selling switchgear into data center applications with some of the big customers being the likes of Meta and Microsoft and Amazon. And so with a bit of a chill or caution coming over, the capital spending intentions for some of these hyperscalers, and some folks starting to question the return on investment that the hyperscalers are going to earn on their AI spend. The stock has faded in sympathy, but we do think, we've seen this before, and we continue to believe that we're still in the early innings of this, and that the demand is going to come back, and this company will continue to grow rather quickly as it has done over the last number of years.
Okay, so one to hold on to or even pick up with that drop. All right, that's all the time we have for phone calls today. But stay tuned. We have Brian Madden sharing his top picks. That's coming up. Welcome back. Time now for Brian Madden's top picks. His first one is Nutrien on the TMX fertilizer maker. Wondering what you like about them. And I think potash is still being tariffed by the administration south of the border. Are you factoring that in as well?
Well, I mean, who's to know? Have we checked our truth and social media accounts the last 20 minutes? There's lots to like here, Marilla, actually. This is the world's largest crop nutrient business. It's got upstream segments mining potash and phosphates and producing nitrogen fertilizers, vertically integrated with a downstream retail farm supply store segment of about 2,000 outlets, primarily in Canada and the United States, to a lesser extent in South America. And the crucial game changer for us is we think that the commodity prices bottom for all three of their key crop nutrients, namely potash, nitrogen fertilizers, and phosphates. And that's bolstered by slowly improving cash crop commodity pricing, not universal, but the big ones that are farmed intensely in the United States are improving. And the imperative on the part of farmers to replenish the soil that they've depleted of nutrients by sparing application of some of these fertilizer inputs when prices were sky high after Russia invaded Ukraine and drove a lot of supply offline. Beyond that, there's a bit of a self-help program. They had some missteps in Brazil, so they've taken some management changes and some operational steps to improve the profitability in that business. Beyond that, we've got a discounted valuation at a probably cyclical trough in earnings power here. These shares are trading at 1.1 times book value and yielding 4.1%. Both of those are pretty advantageous relative to the long-term averages ever since the two predecessor companies, Agrium and Potash Corp, merged. In 2018, the averages have been a 3.5% dividend yield and 1.3 times book value, so pretty good value there. And although the shares have bounced a little over 20% off their September lows, they're still more than 50% off those spiky highs they got in 2022 when potash prices went briefly over $1,100 or $1,200 a ton. Now they're around $320, $330 and moving higher. As to the tariffs, you want to tariff potash, good luck to you. The United States produces 5% of its own potash. They import 70% of it from Canada. So if you want corn and soy and wheat to be produced in economic quantities in the prairies or the heartland, the red states, you need potash. So it would be sort of self-defeating to tariff it for the long run. Candidly, I don't even know what the status is of those particular tariffs. It's very difficult to follow from one day to the next.
Absolutely.
I know they were initially scoped out for a lower rate of 10%
Yes.
along with energy, though.
So self-defeating, though. Sometimes they like to go that way. So we'll see what happens. All right, your second pick is UnitedHealth on the New York Stock Exchange. They are health insurance providers there. What do you like about them moving forward?
So this one is a bit of a fallen angel, Morella. They had a pretty disappointing quarter and severely lowered their guidance for 2025 last week. The shares pulled back their third biggest drawdown in 30 years, down something like 26 or 27% in a day. And so you've got a company that is the largest healthcare company in the United States. 80% of the business is healthcare insurance. They insure 51 million members across individual and commercial or group insurance plans, and also covering Medicare and Medicaid insured lives, the state and federally funded programs for seniors and low-income individuals in the U.S. They're taking market share in every segment that they operate in. In light of some of the funding pressures on government-funded healthcare insurance, that is curtailing their short-term profitability. But we believe it's building long-term value for their shareholders, given secular trends in demographics and morbidity in the United States and the growing share of the sort of overall economy that healthcare spending comprises down there. It's got a fortress-like balance sheet, an A+ credit rating, and so they're buying back their shares rather prolifically with their free cash flow at what we think are pretty discounted valuations. Shares trading at 15 times earnings versus the 5-year average of about 19.5. So I think it's a pretty good entry point, and we think 12 months time very likely to be higher, probably much higher. In 5 of the prior 6 instances when it had big drawdowns like this, it doubled in the next 12 months. Not saying that's going to happen here, but we think the odds are sort of tilted more to the reward and less to the risk here, even though sentiment is bad on this one right now.
Got it. Okay, let's get to your third pick then, which is Bombardier. Of course, Canadian company, private aviation, made some big moves a few years ago. What do you like about Bombardier in the next couple of years?
Yeah, so I think you hit the nail on the head, Marilla. The moves they made a few years ago. So this is not your father's or your grandfather's Bombardier. This is a very focused company with a single segment focused on private aviation, making the Challenger and the Global Express long-range and medium-range business jets. They divested the train division and the commercial aviation division. And now, increasingly, a lot of the revenues come from aftermarket parts and service. That's obviously less discretionary than the big-ticket new jet purchases. And it gets to be a bigger and bigger addressable market opportunity with the increasing number or the larger installed base of existing Challengers and Global Express jet planes in operation. And then beyond that, there's a growing opportunity in a small but high margin segment where they adapt. I think it's on the chassis of a Challenger aircraft. They equip NATO allies with militarized planes that they use for command and control and reconnaissance missions. And so increasingly, the imperative for European NATO members to actually fund their NATO commitments is sort of gelling together. And so we think they're more likely to be inclined to make those purchases from Bombardier than from a U.S. aerospace supplier. So lots of ways to win here, notably deleveraging and big free cash. So it's just becoming much more investable. So we like it.
Yeah, we like Buy Canada. All right, Brian Madden, got to leave it there. Thanks for joining us. And that's it for Market Call. We'll see you again tomorrow.